In the kaleidoscope of global finance, the Australian banking sector takes on an almost prismatic quality, reflecting, refracting, and reimagining their path through the high-wire act of commercial and residential real estate. The banks down under have a peculiar liaison with real estate, distinctive from their American counterparts. This tight embrace is much like the death-defying clutch of the koala on the eucalyptus. Peculiar, yes, but also immensely telling, providing insight into the vast landscapes of Australian commercial and residential real estate, each with their own unique ecosystems and idiosyncrasies. Voyaging into the unknown percentages of the Australian bank's exposure to real estate, we unearth a fact as dazzling as the Southern Cross itself. The Australian real estate market is intriguingly structured. A concentrated lending market, stringent covenants, and a prevailing trend of short-term, floating-rate loans dominate this landscape, presenting a drastically different vista than the sprawling plains of U.S. real estate. These distinctions potentially culminate in a unique cocktail of risks associated with commercial real estate lending. Australia's financial climate remains, by and large, balmy. Its banks have continued to weave their ties with commercial real estate, albeit whilst treading more lightly in the realms of office, land, and retail exposures. A looming cloud, however, is that approximately 35 to 40% of all Australian bank commercial real estate loans will reach maturity in less than a year. This may rain down stress on these banks, especially if the economic climate turns stormy. But it's not all doom and gloom in the land of kangaroos and wallabies. The U.S. real estate market may have buckled under the weight of substantial rent reductions, but Australia stands defiant. Yet, a sudden leap by the Reserve Bank of Australia in hiking base rates could rock the boat, impacting debt serviceability and potentially prompting a revaluation of equity. Peering into the crystal ball, it is evident that the echo of past deals could reverberate into future defaults. Those transactions from the low-interest period of 2021 and 2022 might prove to be Achilles' heel, potentially resulting in reduced loan-to-value ratios and improving the risk-return outcome for new deals stitched together in today's fabric of time. Lamentably, a precise breakdown of commercial and residential real estate on Australian banks' balance sheets remains shrouded in mystery, a secret perhaps guarded jealously by the Reserve Bank of Australia or concealed in the labyrinthine financial reports of individual banks. This ballet of finance, a pas de deux between Australian banks and real estate, calls for deeper introspection and analysis. At its heart, it's a story of structural disparities, impending defaults, and the colossal impact on Australia's financial stability and broader economy. The Australian banking sector continues to dance a high-stakes tango with real estate, each careful step resounding across the global financial stage. Their performance, poised on the precipice of risk and return, is a mesmerizing, yet cautionary tale of resilience, adaptation, and survival in the world of finance, a world as volatile as the turbulent Tasman Sea. Watch closely as this dance unfolds, for it promises to shape not just the narrative of Australian real estate, but the broader saga of global financial resilience. Article by Maria Irene.